So we're going to talk about tax-free retirement. Sorry, I couldn't get that out. And tax-free retirement is typically, well, there's different ways you can do it, but let's just stick to the topic today. And this is coming back to premium finance on some of the other videos that we did. If you had the ability to be able to pay in a chunk of money per year for, say, 5 years, and then you wouldn't have to pay anything else in, or you could start a separate plan and do it again, was that something you'd be interested in? Well, for most people, yes. If you make over, say, $120,000 a year in household income, this is a possibility. There is a particular company that I work with that they will allow you to, I believe the minimum is either $20,000 or $25,000, to put in $20,000 or $25,000 a year for 5 years. And they will match that for those for 5 years. So say it's $25,000, $100,000 will be paid into this life insurance policy that will yield an average, it has an average return, typically 4 to 5%, probably maybe a little higher, it just depends. Some of these even perform better than that, depends on the market volatility. And really with the market volatility, the more volatility in some cases, the better. But that's for another video to explain how that works. But in this scenario, you're paying that for 5 years, but it actually gets paid in. So say it's $100,000 a year for 5 years, and you're only paying $25,000 of it. The next 5 years will be picked up by the bank that's financing this 100%. Now, that's an amazing deal, right? Especially not having to have collateral. Your collateral is essentially your contribution in this situation. So it helps for them, to mitigate any losses if for some reason you stop the program ahead of time. But the way these things work, they work out really well 99% of the time. And the way it works is that in this scenario where you normally would be able to take out loans out of a policy and you'd have liquidity, well, you don't have liquidity. So just look at it as the same scenario as using an IRA or a 401k. You really don't have liquidity. You might be able to take some loans out, but it's not ideal. In this case, you can't touch the money or the loan comes due. But the amazing thing about it is, after 15 years, so say let's just say you're young and you want to do this, or maybe you're 50 and you're like, hey, I need to add to my retirement plan because I've had a Roth or I've had a regular IRA, and I haven't been able to contribute more than, they have a cap on contributions, like say $6,000 a year. 401k is 20, so it's a little different. But I haven't, based on, the 4.3 or 4% rule, depending on who you talk to, for income on the back end without running out of money, depending on who you talk to, well, you start looking at what that's going to be. And then a lot of people who are, say, 50 are thinking, well, that's not going to work. That's not going to be enough. So, and then there's some people who use this in place of their retirement. Maybe they haven't planned retirement. This allows you to supercharge your retirement. You're not touching the money. And at the end of year 15, basically day one of year 16, the loan will pay itself from the cash value. And then there will still be a nice chunk of money left. And with that, you'll know ahead of time, based on averages and a conservative outlook of what that'll look like. But essentially, you haven't put that much money in. And if you were to, let's just give you an example, you were to put in $100,000 or $125,000 over 5 years, but you ended up with an income of, say, $50,000 that would last you 20 years on the back end, like $50,000 per year. And that may not be exact numbers or exact math, how that works out. But, all these numbers are run at the inception of starting the plan. Before you start the plan, the illustrations are run, all of that stuff's done, all the probabilities and stuff like that is put into the equation. But you're able to look at it as you're getting a nice return, and you get the best bang for your buck. You're not going to get that out of most retirement plans. You're really not. And the only other retirement plans you're going to look at is like executive retirement plans that are, using life insurance in most cases, and companies are sponsoring these things and owning them. And then, they have it set up to where they have a period of time where it's vested. But getting back to the subject, in this case, you're able to contribute for 5 years, and you're able to get 10 years worth of payments, and even your contribution is like 25% of those 5 years of what's actually going into the policy. And then on the back end, when you get that money that you get, so let's just go back to the number I was using. Let's just say it was $50,000 because, they put in $100,000 a year for 10 years. So it's $1 million, right? Unless my math is bad. It's $1 million. So if you get $50,000 a year for however many years it is, whether it's 20 years, 30 years, whatever, from age 65 to age 85, let's just say that, and you got $50,000 a year, it's tax-free. And the way this is done is, one, it's tax deferred throughout the growth process, and it's not even anything you have to file on your taxes. There's no place for this. People don't even have to file a return with regard to this. Now, you'd still have to file a return later in life in retirement, just stating that you had zero taxable income. And then you might have to put on there that you had non-taxable income. But either way, you're not being eroded by taxes. So you have taxes on an IRA, and say you were able to get the same income on an IRA, you'd have to pay whatever tax bracket you were in at that time, because the money was tax deferred and it was never taxed in the beginning. This other money is considered after-tax dollars. So it's a tax-free retirement. And I mean, it's actually pretty amazing if you think about it. And there's some people, what they do is they pay in for 5 years. Then, of course, it's hands off for the 15, but at the end of the 5 years, they decide, you know what, this seems like an awesome deal. I'm going to do this again. So they basically pay in for 10 years, double what they're doing. They start a new policy, a new loan, and do it all over again. And, realistically, they're just going to double up their money. So if they were going to make 50, now they're going to make 100,000 a year, for example. Some of it's going to have to do with the performance of the policy, but for the most part, in theory, they've added to their retirement. And maybe they do have other taxable retirement, such as 401k and and those other things where they have required, minimum distributions and all that other stuff because the government wants their money. They want the taxes on that because you didn't pay taxes on that money whenever you put it in, and you got a tax write-off for it. You got to subtract that amount you were contributing from your income. So they didn't tax you on it. So what happens whenever it comes out? You're taxed on the whole nut, right? You're taxed on the gains. You're taxed on the original money. You're taxed on everything that comes out. So if you take out 50, you pay taxes on $50,000. So this plan is amazing. And, for those who qualify, like I said, let's just say $120,000 or more a year in household income, which isn't unheard of because, husband and wife both working, let's just say they both make $60,000 a year, it's doable. And if they do better than that, even more so. So it's a great way to build a nice tax-free retirement. And and the reason why I stress tax-free is because you reduce your income with the taxes normally. Let's just say it's 30%. Let's just be easy, say 30%. Well, 30% of $50,000, just without going through all the calculations, let's just look at it as 30%. Let's just say it's $15,000. So now you've reduced your income $15,000 and you're really getting $35,000. Well, that's not what you signed up for, right? You were looking at it as this is what I was going to get in retirement. And now you have to have something to add to that aside from Social Security, which everybody knows Social Security doesn't pay enough, or people wouldn't be putting money into IRAs and 401ks or even scenarios like this, or maybe they're putting it into a life policy that's structured for cash accumulation and intending it on using it in retirement. And they're doing it because they're putting after-tax dollars into this policy, and then the money that they get from the policy, the way it's done to pull the money out of the policy is completely tax-free. So anyway, that's a little insight on that. If anybody's interested, I'm here to help. I can run scenarios for them that want to actually look into this. Of course, it has to be in the U.S., but it's an amazing tool. It's an amazing tool because there's so much money going in there. You're not actually paying it back with your own money per se. Yeah, there's your contribution, but the money that you're left with is still a substantial amount, and you more than get your money back. You make money. I mean, you're using leverage. It's just like anything else. You go and buy a rental property and you use a loan on the property. It's the same idea. You're paying 20%. 80% is put out there by the bank, except in that case, you actually have to make payments. But ideally, if you have a tenant, that pays the payments, so you're not actually paying payments yourself. This is kind of the same idea, except the policy, the growth in the policy pays your payment. It's a beautiful thing. Anyway, please, if this was helpful, please, the content, hopefully, you enjoyed it and it's, informational. And if you do, please like the video, subscribe so you get the newest videos when they come out, and hit the notification bell so you'll know, you'll get the little bell up there, lighting up red whenever one of these comes out. Have a great day.